You're listening to The Real Well Show with Kathy Fettke, the real estate investor's resource.
I am very excited about today's interview on The Real Well Show. We have Gary Beasley joining us, the CEO and founder of Roofstock. He was just a normal guy when I met him years ago. Today, he is a leader in the institutional space, a true disruptor of the single-family rental business. I'm Kathy Fettke, and welcome to The Real Well Show. Gary Beasley started and launched several successful companies, leading two of them through IPOs, ZipRealty as CFO and Starwood Waypoint Residential Trust, where he was a co-CEO. That is now part of Invitation Homes, the largest single-family rental home REIT in the U.S. Gary was also instrumental in acquiring and integrating more than $800 million of resort properties for KSL Resorts and served as CEO of Joie De Vivre Hospitality. Gary was named a 2019 Top 50 FinTech CEO by Financial Technology Report and Housing Wire's 2018 HW Vanguard. He earned his BA in economics from Northwestern and holds an MBA from Stanford. And he's here with us today on The Real Well Show. Welcome, Gary. It's really an honor to have you here.
Thanks, Kathy. How are you?
Good. I think I first met you at Goldman Sachs when we were both nominated for top 100 most intriguing entrepreneurs. Remember that?
That was a while ago. Yeah, I wonder if we're still intriguing. Back then, perhaps we were. But yes, I do remember that, actually.
That was really cool. That was a great event where I think we were the only two real estate groups there, but I'm not sure if it was, I won it 2 years in a row, and one of the years the Uber guys were there, and like some big names. I think Elon Musk one year. So anyway, it was happy
Good
to
company.
represent. Yeah, happy to represent the real estate side of it. And I think at the time you were there because you had a real estate fund, single family fund. What was it at that point?
It was called Waypoint Homes.
Waypoint,
at the time. Yeah, we were one of the first to buy single family rentals back during the great financial crisis. So back in January of 2012, I think we were the first group to get to 1,000 homes, which was over 10 years ago, and 1,000 homes was a lot back then. By the end of that first quarter of 2012, Blackstone was buying 1,000 homes a week. So that's how much it changed. It took us a couple years to get to 1,000 with friends and family money and some of our own, but then the institutionalization really started that quarter. That's also when home prices bottomed, if you recall, and they started going up in the first quarter of 2012. So it was interesting times.
Yeah, looking back, I had been syndicating since 2009. We were buying foreclosed land, foreclosed subdivisions, 10 cents on the dollar, syndicating it. And I had the idea of doing what you were doing, which was to buy homes that were so cheap. In some cases in California, 75% less if you bought in certain areas. But I didn't know how to manage it. And so, but I knew it would be a good idea. So going back to that time when I guess like you started with friends and family money, how did you do that and how did you manage it all?
Yeah, so I remember it very vividly. So Doug Bryan and Colin Wheel were my partners at Waypoint back in the day. And I remember Doug talking to me at my daughter's soccer game saying, hey, I think I'm going to start buying some homes in Pittsburgh and renting them out. And I thought he was talking about Pittsburgh, Pennsylvania. This is Pittsburgh here in the Far East Bay. I said, why would you do that? He said, they've dropped. There were $400,000 homes you could buy for $125,000 and get a 10% net yield. They said, that's interesting. So it by far had the best yield of any real estate asset, but you had to believe in the rent. And even during the financial crisis, we didn't see rents drop in single family homes. Prices dropped in that Far East Bay, like you said, 65 to 75%. And the rent stayed pretty constant. And then all these people, unfortunately, had lost their homes. They were now renters. So there's this incredible renter demand. The supply of available homes to rent was lower than the demand. So there were waiting lists. So we just started buying homes then with our own money and with some friends' money and raised, I think, 9 or 10 small funds every kind of 6 months or so. And then we said, you know what, we should just go big and raise some institutional money and try to build a platform. And that's what we did. And we raised $200 million of equity from a private equity firm, and then started going and actually put the first debt facility in place with Citi back in 2012 in the space, to which helped others figure out how to scale this. But yeah, lots happened since then, as you know.
A lot. And in retrospect, I think a lot of people think, well, it's so obvious. Why didn't everyone do it? But in the moment, when the world economies are collapsing, when Wall Street giants like Lehman Brothers come crashing down, people get paralyzed.
You're right, Kathy. I mean, it's to us, we thought we were missing something big. So we're seeing the fundamentals of this. The worst case is you have a home with a 10% yield that doesn't go up in value anytime soon. But we knew it was California real estate. It's eventually going to recover, and you're getting paid to wait. But it's funny, the herd mentality, when people aren't, if others aren't doing it, it doesn't seem like a good idea. The only mistake we made is we didn't buy enough houses back then. We just didn't have enough money. We were buying as much as we could. But we just, to me, it was an interesting way to think about it, is if we were able to build a platform, we could create enterprise value by building an operating platform that has value. Worst case is we had houses that we got a great deal on that we could just sell in the open market to homeowners. That's one of the unique things about single family rentals, is you have two exits. As you know, you could sell it to an investor who's looking for the yield and total return, or just a homeowner, and you could sell it vacant. So very few, there really aren't any, I think, other good analogs in real estate where you have two prescribed exits that are both legitimate without having to do anything to the physical asset. So it's like an embedded option that doesn't get valued, I think, when people buy these things.
100%. So again, I'm just going to climb into your mindset for a minute, because I did have people come to me showing me what you could buy in Pittsburgh and that whole area out there in the East Bay. I lived in Walnut Creek, so I knew the area.
That's right.
What was happening in Walnut Creek? I mean, you could buy condos for $60,000. It's incredible. What I couldn't grasp, and that you did, was how to build the team, because there's a few pieces here. You have to know what you're buying. You have to maybe pay the right price, make sure you understand what needs to be done to fix it. You need to manage it. You're using other people's money. You don't want to lose their money. Like, how did you pull the pieces together? I'm a visionary and I could see it. I just didn't know how to pull it off. So would you say you're a visionary or an integrator or both? Or like, how did you do it?
Well, I would say it was clear to my partners and me. I think we had the vision of what we wanted to build, but we've also built things in our past. Doug was a longtime real estate investor, liked to get his hands dirty. I've run other businesses, and so I've always been attracted to operationally intensive real estate that's in the path of growth. And so and where you could apply technology and new business processes and create value. And so I spent a lot of time in the hospitality world, obviously very operationally intensive, a lot of moving pieces. A hotel is more an operating company than a real estate asset in many ways because of all the services. So we knew we could apply technology and automate a lot of this stuff, both the underwriting and the property management processes. And I think there's two reasons the institutionalization happened of single family rentals. One was the financial crisis, the great financial crisis, which created the entry point, right? Created great yield. But the second, and as important, was the advent of cloud computing and mobile computing. Mm-hmm. So you could go through, and at the time it was iPads. Now people are using their phones. We built out all the technology, so a technician or a construction estimator could go through the house and just estimate things on the iPad, and all that data was structured. It got pulled into and immediately went out for bid and contractors. So we built our own platform. So rather than using the yellow sheets and, that doesn't scale, people could do a few of them, maybe 5 or 10 of them, but we were doing hundreds of them. And we needed to build technology. And so that new technology really, it would happen to be available at the time when this crisis happened. And so we leaned into developing out a technology platform, and then others did the same thing and built out their own. So yeah, that's both of those were, I think, really critical in getting being able to operate these things really as efficiently as apartments. If you look at the margins, the net operating income margins of the large single family rental players, they're very similar to multifamily, very similar to apartments, because you can operate them quite efficiently now at scale.
Yeah, it didn't hurt that you were in the San Francisco Bay Area with plenty of tech help there. I would think, no, it is. That's a really fascinating way to look at it, because we're talking just a few years before that. We didn't have the technology. It was just being created. People didn't even have phones, like cell phones.
You and I can remember those days, right? You'd go travel with someone, and if you lost them, you were lost, right? It was different times. Yeah.
It was a beautiful thing when a pager, was like, oh, you could, anyway, we've come a long way. But before, I mean, just a few years before, property management was archaic. They didn't have systems. There was no uniformity. And that's why I was afraid. So it's really cool to watch you be on the forefront of what just blew up a few years later. I mean, I think it was 2012 when Warren Buffett said, if I could buy a few 100,000 homes, I would, if I knew how to manage them. And that's how I felt. I would too. I knew how to raise the money. I knew where the deals were, but I didn't know how to manage them. And that's the key. So what are some of the changes that you've seen over the past decade in terms of managing a large portfolio? Besides technology, of course, like you just said.
Yeah, well, certainly, I think the technology has helped a lot. I think a lot of it has just been experience, and then multiple players coming in and trying different things and sharing best practices. I'm involved in the National Rental Home Council, where we have a lot of, we have regular meetings, and we compare notes on best practices, and it's both for large and small and medium-sized owners. So I think it's been a very collaborative decade of people really wanting to get better. I think that there's a lot of good things. I know there's institutionalization gets kind of a bad rap, and that could be the topic of a whole podcast. But some of the positives of it, I think, are evident in what's been happening in the space with investing in systems, groups being able to build infrastructure to be responsive to tenants, to residents, to deliver better service, improving the physical plant, and building homes to rent is a huge thing now. For the last few years, you've seen an explosion of homes being built specifically for renters, and they're being built so they could cater to renters better, and they could be serviced, for example, from the outside without having to disturb the resident. You could get to the HVAC system and the boiler and things like that. So there's things you could do from a design standpoint that help both the resident have better experience and it be a more profitable investment. So, and then the financing markets obviously developed. The debt markets actually developed faster than the equity markets. Interestingly, over that decade, you were seeing securitization start to happen and trade very well before the public equities of the big REITs traded well. So it was interesting that the public investors seemed to get more confident with the underlying collateral and the debt before the Invitation Homes and American Homes for Rent started trading really well. So we've seen that mature. It's just seen the financing markets develop. And I think we've seen the space become viewed as a legitimate asset class now, where I used to get laughed off the stage at conferences saying someday people are going to be looking at SFR, single family rentals, much like multifamily, and people are laughing and like, come on, you can't manage homes like that at scale, blah, blah, blah. And so now if you read some of the Green Street research, which they're one of the big REIT analysts that most well respected, they cover single family rental. And I think the last report I saw, these single family rental REITs had the second lowest cap rate of all of the different asset classes. I think industrial was slightly lower, but SFR was lower than multifamily, than really any of the other classes, meaning people have confidence in it, and they've been trading to a level that's attractive. So it's all happened quickly. A decade really is a lot. A lot has happened in a decade for this asset class. That I think has been, for the most part, pretty positive for all the participants.
Yeah, and you've been at the forefront of all of that. There was a time when those of us mom and pops, boots on the street, were looking at institutional buyers going, what are they thinking? Overpaying. I think in the beginning, many of them just had a bunch of, they were great at the acquisition. They had a bunch of money. They'd buy homes, but they would just sit vacant, or they didn't know how to manage it, right? Remember those good old days? We thought for sure they were going to fail. They didn't.
It's so funny you say that. I was telling this story the other day. I won't mention the firm, but in the early days, and this was in 2012, one of the big institutional players showed up at an auction and said, I'm going to buy everything today. And everyone, all the people who were there kind of laughed.
Yeah.
And she did. She had authorization to buy every house that day. And they were sending a message. They're like, okay, we're here. And you guys could keep coming, but we're going to keep winning. So you might want to go somewhere else, type thing. And we were saying, oh, this is crazy. They're overpaying for everything. But what they realized was they were buying at such a discount to replacement cost. We would get to our max bid, which was driven by our underwriting, and we'd just stop. We didn't have unlimited money. So we were just trying to optimize every investment. They're just saying, hey, if we could buy at a meaningful discount to replacement cost, we're going to buy it. And they had access to that kind of capital and did it. But what's interesting is back then, that's really what the economy needed. It needed a lot of capital to come in and renovate all these homes that had been foreclosed on, and many of which were run down and not habitable. And so it really was a good kind of confluence of private enterprise and what the housing market and the neighborhoods needed back at that time. So I remember my first day at Waypoint, I said, you know what I'm going to do? I'm going to get out in the field and I'm going to kick the tires. And I went out to one of these neighborhoods, and I think it was in Antioch, which is near Pittsburgh, right? And one of the first homes I saw, we were going in, and our guys were like, the renovation was about to start, so we're pulling out all the crap that had been left in there. And this woman next door in this robe and fuzzy slippers came over and gave me a hug. And she said, thank you. I'm so glad somebody bought this house. Because there's been a bunch of drug dealers in there. My kids were afraid to walk. They'd have to go around the block to go to school. But that was a little microcosm of what was happening. And so, we kind of, cleared them out, cleared everything out, renovated it. And so we turned the worst house on the street into one of the best houses on the street. And so that's the narrative that's not really discussed a lot, of what the positives of investor capital, and whether that's large institutional investors or mom and pop investors who can buy assets that need to be repositioned, and you really can turn them into some of the better homes in the neighborhood. And I think the stigma of renting is really diminished over what it was certainly a decade ago. I like to say, when you go down the street, I'm looking out now, I don't know who owns their car or who leases it. Who cares? Yeah. It's a car. It's a financing decision. So I don't know why the same thing can't be with housing. Why can't people choose their neighborhoods where they want to live? And I do think renting does provide real upward mobility for families to get into better neighborhoods and before they're able to buy it. And so I think there's some good that comes from it.
Absolutely. I mean, you reminded me of, I went about it a little differently. I wish I had put it all in a fund and held everything, but instead I helped other people do that. And we would take busloads of investors through those streets, like you said, that homes were boarded up. They were full of squatters and drug dealers, and nice neighborhoods just turned overnight. And people who remained there, who were still living there, would look out their windows and not recognize their neighborhood, and they were afraid to go outside. We would drive through those streets. Investors in the bus would buy up all the homes. We'd fix them up and return those neighborhoods. And just like you, the neighbors would just thank us. So I do hope that somehow that gets out there of how investors did really help. But fast forward to today, obviously institutional funds have grown a lot, even though landlords have been around for a long time. Would you say that between the current like mom and pop landlords and institutional landlords, are there more rentals on the market or just more institutional landlords?
I would say that there's more rentals on the market. Although when you look at home ownership rates have really rebounded as well, right? So they were back during the financial crisis, they got really low, kind of into the low 60s, and now back to the mid 60s. They've sort of come back, but we've continued to add some supply with homes being built and things. And we track the data. There are more rental homes now than there were back then, but there's more homes too. So, I think there's roughly 20 million rental homes by our count when you count two and 4 unit buildings, which really we consider single family as well because it's the same financing. And so it's up a bit, but the institutional folks own, call it 2% of that, 2 to 3%. Maybe it's 500,000 or 600,000 homes that are owned by all the large institutions out of the roughly 20 million rentals and the 90 plus million homes. So it's pretty small. There are certainly neighborhoods where it feels like those folks have a disproportionate impact. Those are isolated, but when you do look at it broadly across the country, it's pretty small.
Yeah, and yet that tiny percentage gets so much flack and there's so much fear. Why do you think people are afraid of an institutionally managed, Wall Street managed rental versus my rental? It seems like you got more money, you can maybe have different standards, have better systems. Why are people so afraid of Wall Street? And not even Wall Street, just institutional money.
Yeah, I don't know. I think there is. People I think maybe associate Wall Street money with the financial crisis and foreclosures and people getting kicked out of their homes, banks and all that. It's a longer story to really think about and unpack. I think people think about maybe being able to negotiate better with an individual owner. So maybe they're going to be a kinder, gentler owner who understands their personal circumstances rather than being purely financially motivated. I think that's probably part of it. And there are circumstances where that's probably the case. And
I just give my tenant a 5-month break. So you're right.
No, where it's more, I've sort of done the same thing in some rental homes that I've had. It's not purely, you're not purely driven by the numbers where the SFR operators are largely, although I would say during the financial crisis, did a very good job of keeping people in homes, working with folks and kind of quietly doing a lot of that stuff, things that they probably did not need to do. But I think that's probably what it is. I think that the positive though is these larger companies have brands to protect. So they follow fair housing laws. They fix things when they're broken. People get their security deposits back as long as the place is in good shape. All these things that can be a bit of a crapshoot with a mom and pop landlord, who you could get a really good landlord, you could get a really bad landlord, and they may tell you to go pound sand. They're keeping your security, but so sue me. Are you going to actually take them to court over $1,000? No one does. So you do get a little bit more assurance. It's almost like staying in a flag hotel or a chain hotel versus an independent that you've never heard of along the roadside. You sort of know what you're getting to some degree with these, and that has some advantages.
That's a great explanation. Some of the things I've heard are, they're just going to try it out, not like it, and then dump a bunch of properties on the market all at once. I hear that all the time because apparently funds don't care about losing money. I don't know.
That's not true for sure in my experience, or they're not repeat fund owners. I think that was an argument back in the early days. I think people were thinking it was more of a fix and flip mentality where people were going to just buy them and then sell them all once they went up in value. And we haven't really seen that be the case. I think what these investors have realized is there's value to the income as well as the appreciation, owning these things over time.
Mm-hmm.
And even when they do sell them, if they sell them in a portfolio to investors, the signs never go up in the yard. It doesn't affect people's individual property values, because even if there are 5 homes in a neighborhood, part of a big portfolio, and it trades, it's almost like changing the servicing on a mortgage, right?
Mm-hmm.
It's no one even really knows. So the homes have traded, but it certainly hasn't been dumped onto the market.
Yeah.
And you know what I mean? And influence people's values that way.
Yeah, I was never worried about that happening. I did wonder, and you cleared it up earlier, but I wanted to ask the question here. I wondered if a lot of these funds that own thousands, hundreds of thousands of properties were on adjustable rate mortgages and feeling the pain right now. But you said they're not.
They're not. For the most part, they are enjoying fixed rate financing through securitizations, which the securitization market was really humming, the last few years, and a lot of the owners took full advantage of that. Now, in the UK, it's different. In the UK, there's, for the most part, short-term floating rate financing, not 30-year fixed mortgages. You can't go very long in terms of the term. So you are seeing a lot of pain in the UK of people's interest rates going up and them having to refinance at higher interest rates and lower values. And so, we benefit from a much different financing system here, which does allow that fixed rate longer term financing. But as a consequence, we're actually seeing some real opportunities to buy in the UK where there's a little bit more distress, people looking to sell. There's also in the UK a big push towards upgrading the homes from an environmental standpoint. They have what's called an EPC scale, which is a scale that measures carbon emissions. And all the rental properties there in a couple of years are going to have to be at least of a certain rating. And if the properties aren't improved to that rating, they won't be able to be rented. And so there's an opportunity for landlords to come in, put in that money, like new owners, and upgrade, whether it's a heat pump, insulation, windows, electric appliances, things like that. You really reduce the carbon output and the utility costs for the resident, some of which can be recouped and can rent. But then you have a property that's then sort of future-proof for the next few decades, which needs to happen, especially with really old housing stock like in the UK. Mm-hmm. So you're seeing some capital starting to look at that market, that because of the financing dynamic that you mentioned about the floating rates and the term. We're obviously going to be experiencing a really interesting time here over the next couple of years in the commercial space here with that couple $1 trillion of loans rolling over the next 2 to 3 years with regional banks. It will be very, very interesting to see how that transpires, and to what degree it bleeds into the broader economy or residential, I think TBD.
Well, and that's the thing that a lot of people who are expecting a housing crash are forgetting, is that U.S. housing, 1 to 4 unit, is probably one of the most stable asset classes right now because of those fixed loans. Back in 2008, it was adjustable rate mortgages. That's what brought housing down. But today, the majority of homes are on 30-year fixed or fixed rate loans at very low rates. Other countries don't have that. So I agree with you. There's going to be opportunity in other countries. I know Canada is experiencing the same thing. Their mortgages went way up because they're adjustable. And then, of course, here in America, in the commercial real estate world. So
it's obviously, it's obviously keeping our supply down too, right? Because I know so many people anecdotally who have 2.5% mortgages who have sold their home and moved and kept it as a rental. Yeah. Because they don't, that 2.5 or 3% mortgage is an asset.
You can't give that up.
You just can't give it up.
No.
And so that home is not being sold into the market. So the inventory is so much lower than it's been historically, which helps prop up prices. And so, I think a lot of people are surprised there hasn't been a big correction in housing. I think what you saw was prices sort of peak, and they peaked and then they came back to where they were kind of a year ago, and then in the first quarter, and then have been going up steadily since then. But it feels like they've, for the most part, have bottomed and are going up again, but they never really experienced that 20 or 30% decline that I think a lot of people expected, because I think of this lack of supply that's partially driven by, ironically, the rates, keeping the rates high has kept home prices propped up because of this lack of supply, which is almost counterintuitive, right? You'd think, oh, mortgage rates are going up, so home prices need to come down. And there's certainly that impact where people can, I think they were just buying maybe a different house. They were buying what they could afford, but it was a different house, but the supply was just very constrained.
Yeah. That's the dilemma is high mortgage rates actually are doing the opposite. They're keeping home prices high because it's a stuck market. Hopefully that changes soon. But coming back to you and where you are today with just such an insider view of how things are going in the rental industry because you at Roofstock, what's your portfolio at this point?
Well, we're a transaction, we're an investment platform.
I should say, what is Roofstock? Because I think there's misconception about it.
Yeah, think about Roofstock. We're a real estate services company. So I like to describe what we're doing as providing real estate investment as a service. Mm-hmm. So if you're an investor and you want to buy a home, sell a home, manage a home better, you could come to Roofstock and rent our platform. So a little bit like I was talking about cloud computing, you could come in and you use Roofstock almost like your real estate investment cloud. And you don't need to be an expert. We're catering principally to institutional capital now. We have historically also had a pretty robust retail business. Our focus is largely on the institutional segment, although we do work with some high net worth individuals as well. We do have a product called Stessa, which is for retail investors, which is free. It's a piece of asset management software to help you manage your single family rental home or homes better. But really, our platform is designed to apply data and technology and our expertise in the sector to allow transactions to happen more efficiently. We can help people build portfolios, which will then manage for them. We can help investors sell portfolios or homes individually. And so we've probably done about $6 billion of trades over the years. We currently manage about 15,000 houses ourselves for investors who own the assets. And we're really kind of in the market, helping buyers and sellers and kind of creating liquidity in the space. We're also doing some kind of cool stuff. I don't know if you saw, Kathy, with blockchain, where we've tokenized a few homes and we've sold them on the Ethereum blockchain. We think it's early, but there's some promise there to package up homes that could be sold in a frictionless way. So that's a little bit of a skunk works project that we're working on. But we're always looking for ways to kind of innovate in the space, try to reduce friction, cost, increase transparency of real estate transactions.
Why do funds sell to each other? Why don't they just keep?
So it depends on the fund, but most funds have a finite life and they need to return capital.
Oh, I see.
5 to 7 years. And so especially the private equity funds, they're much more opportunistic. They will buy, refinance, kind of get it to a separate place and sell. So that's just their business model. Now, the big REITs are perpetual owners, so they don't need to sell anything, but they will sell some percentage of their assets and kind of move chips around. They'll perhaps harvest some gains in areas that they think might have traded up, and they'll sell those, and they'll buy in areas they think there might be more growth, or they'll sell areas where they're subscale to operators who already have scale. So moving some of those chess pieces around, we help a lot of those players with their asset management strategy. We have some technology that can evaluate. We've mapped all 90 million homes. We know who owns them. We know all the institutional owners of the rental homes. So we can see natural patterns of, hey, if you ever wanted to sell a couple thousand homes to generate some proceeds, here's some suggestions, and here's who the buyers might be, and we can help make those trades happen for you. So it's really kind of asset management where the perpetual owners might want to sell certain things. And then you'll have some owners like pension funds and things like that who might just want to buy homes and just tuck them away and just own them forever. So it really depends on the owner.
Fascinating. Well, I've taken enough of your time. Gary, you're so fascinating. Just been so impressed with your career and the growth and all that you've done to raise the level, really, of the real estate investment world.
Well, I appreciate it, Kathy. And likewise, I've always been impressed by you. We've known each other for a long time. And I think it's wonderful that there are resources like you that investors can tap into. Obviously, we spend a lot of time with larger investors. I think it's amazing that you could sort of be a mouthpiece for some of the smaller investors and a resource for them to get access to the asset class. As you know, I'm a fan of the asset class, and I think it should be. It could be an important part of everyone's portfolio to some degree if you've got some investable capital. And I think breaking down those barriers to investing is really important. I think that's one of the things you do a great job of.
Thank you so much. Really appreciate that. Hopefully, with my single family rental funds, we'll get big enough that we could be working with Roofstock that way.
We'd love to help you. Yes.
Awesome. All right, Gary, thanks again for being here on the Real Wealth Show. It's really a pleasure.
Great to see you, Kathy.
And thank you for joining me here on the Real Wealth Show. If you would like to learn how to build your portfolio and get referrals to property teams who can help you do that in some of the fastest growing markets in the country, just go to realwealthshow.com. You can join for free. Once you do, you'll get access to our private portal where you'll get hundreds of free webinars on asset protection, acquisition process, how to understand a pro forma, all the goodies for free at realwealthshow.com, along with a free session with one of our very experienced investment counselors, and again, referrals to teams that come highly, highly recommended by our over 70,000 members at Real Wealth. Again, you can do that at realwealthshow.com. Thanks for joining me.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.